What is up guys, Taiki here. Today I'll be going over two strategies that you can employ on the Terra ecosystem to earn 50 to 60% APY on your assets. If you like the content, please like and subscribe and leave a comment in the comment section below. So let's get started. Alright, so I've kind of foreshadowed on my channel that I'll be going over the Terra ecosystem more, right? 4 of my last 5 videos were on Terra. And today I just wanted to lay out on a spreadsheet like my actual strategy, just so you can kind of understand it better, right? Because I'm doing many things, but if you lay it out like this, it becomes more simple. It might not seem simple now, but throughout the video you'll understand it better. So I'll go over the strategy I'm employing right now, as well as a pure stablecoin strategy if you don't want exposure to Luna. So before I get into the actual strategy, I'm just going to briefly go over how I bridge my assets from Polygon to the Terra ecosystem, because I mostly cover Polygon. So essentially, as you can see here, I ported essentially all my stablecoins from Polygon to Terra, right? As you can see here. And the way I did this is that I essentially took all my stablecoins and swapped it for UST on the Define AMM, right? This is DUFYN.exchange. That's the website. Because there's liquidity for UST here, and you can't use assets like USDC on Terra because it's not native to Terra. You need UST or Luna. There's not that much liquidity for Luna. There's a lot more liquidity for UST. So I just took all my stable coins, swapped it for UST, and I used the Polygon bridge to just take my UST from Polygon to ETH. And after I did that, I just used the Terra bridge, right? So you have to do multiple steps. The website is bridge.terra.money, of just taking my UST here and then bridging from Ethereum to Terra, right? Pretty simple. Transaction fees are pretty low, so it wasn't too difficult, but that's what you had to do. Okay, so that being said, let's go back into the strategy of how I'm actually doing this. So like I mentioned, I initially bridged over 16.4K to Terra. So what did I do with that to earn this much, yield? So this is the layout of the strategy. Essentially converted $6.4 thousand of stablecoins to Luna, right? Because I just wanted a little bit of exposure to Luna because I guess I felt a little frisky, and there's things you can do with Luna when you use it as collateral to borrow against it. And then I deposited whatever I had remaining into Anchor, earning 20%. And then I can use AUST, which is my claim on my Anchor deposit, as collateral to short farm on Mirror. So too much talking, let's actually go into how I'm doing this. So like I mentioned, this used to be 6.4K. Obviously the markets are down a little, so I knowingly took this risk, but it's okay. Because I wanted to do this because I can use my collateral to borrow against it, right? So it's like Aave, you put something as collateral, you borrow dollars against it. And the borrow value, which is $1,500, which I think is a relatively safe amount. I'm gonna be liquidated if the price hits 3.6, which is totally possible, but I'm feeling a little frisky, like I said. So the borrow APR is 15%. So this is how much interest I'm paying Anchor to borrow this much. But because Anchor has these liquidity mining programs, they're paying you 110% to borrow. So my net APR is 95%, right? So this is how much I'm earning on Anchor on this much, right? How much I'm borrowing, so, which is, you can see here, I'm paying 15%, 110%, I'm borrowing this much. So if this rate stays the same, I'm gonna earn $1,400 roughly by the end of the year. Obviously it's gonna fluctuate, but in the time being, this is the math, right? So I have $1,500 of USD that I borrowed, as well as the $10,000 of USD that I have remaining. I deposited everything into Anchor here. You can't see it because I withdrew. I didn't withdraw. I'm using it as collateral somewhere, and now you don't really see it, but you can see that on Saturday, July 10th, I deposited 11.5K, right? And I redeemed some because I earned a bunch of interest, and you need UST for transaction fees, right? Or just any assets transaction fees. So I just withdrew them. So as you can see, I know this might sound a little confusing, but I started with 16.4K. I bought 6.4K of Luna, borrowed this much against it, earning this much interest. With the remaining 10,000 and the 1,500, I put 11,500, right, total, right, just add, and that is earning me 20% interest, which is $2,300. And now I'm going to use this as collateral on the Mirror protocol. because right now on the Mirror protocol, there are these two things that you can do called long and short form, where if you're a long form is like providing liquidity and like basically earning swap fees and Mirror tokens. And when you short form, you literally short an asset and you get paid to short, right? So let's get into the asset that I'm shorting and how I'm actually doing this. So let's get into the tutorial right now. All right, so let's get into how you can actually short an asset on Mirror protocol. So you have to do multiple steps. First, you put something as collateral, right? Because when you short something on Mirror, you put an asset as collateral, you borrow against it, and you immediately sell the borrowed asset in the market, hoping to buy it back lower, right? That's the definition of shorting. In this case, I don't really care if gold goes down. I'm just choosing gold because it's the least volatile asset available. So the cool thing about Mirror is you can use AUST as collateral, right? So this figure you see here is essentially my claim on this much, right? $11,500, which is appreciating 20% a year. So like my collateral is appreciating roughly 20% a year, and I can use that as collateral, and I can borrow against it. Then you set a collateral ratio, and you're going to be liquidated below the minimum, which is 150%, and the safe amount is 200%. Obviously, this depends on like the asset you're choosing. For me personally, I'm going to choose 180%. Though this might seem risky just by looking at this bar, if you actually do the math, it's not that risky. So I did a little simulation here. So if I set my collateral ratio to 180%, and hypothetically I choose collateral as $10,000, just like using round numbers, I know I'm using 11.5K, but I mean, it's math, right? It doesn't really matter what the numbers are. I'm just trying to capture how much gold would have to go up in order for me to get liquidated. So if I use 180% collateral ratio for $10,000, I can borrow this much. And in order for me to get liquidated at 150%, the gold would have to appreciate to $6,667. And the percent growth from this figure to this figure is 20%. So essentially gold would have to go up 20% in like a matter of days in order for me to get liquidated, which is very unlikely. And keep in mind that my collateral is also growing 20% in value, right? So if gold actually goes up 20% in the next year, my collateral ratio would remain the same, right? Do you get the point? So, under 80%, I feel comfortable with this. And with this ratio, I can mint this much in my mirrored IAU, which I'm going to directly sell. And I'm going to get to mint $6,500. So because I'm short borrowing an asset, selling it directly, I'll be earning these dollars. And these dollars I can put back into the Anchor protocol, right? Or I can use it to long farm. So it also gives you the flexibility. It's locked for 2 weeks to prevent spam attacks, I believe, but that's how you do it. And then, it has these things, you agree, and then you sign the transaction. And there you go. That's how you short an asset on Mirror, right? In this case, gold. So hopefully this was helpful. And now, yeah, I'm earning 45% on gold. Shorting gold. Cool. All right, back to the spreadsheet. Okay, so sorry if that's confusing, but I essentially shorted $6,500 worth of gold, which I'm being paid 45%, and that's earning me roughly $2,900, right? And in 2 weeks, right, in 14 days, the $6,500 will be unlocked, right? Because when I short an asset, I'm borrowing it and then selling it, right? So when I sell it, I get UST in return. So with the $6,500, I'm gonna most likely do a long farm on Mirror, right? It depends what the best rates are gonna be in 2 weeks, but most likely I might just like long the same amount of gold, so I can remain delta neutral, or I might just like long like the Nasdaq. I don't know. We'll see. I'll update you when the time comes. Or if you want to be more risk averse, you can take the $6,500 and redeposit it back into the Anchor earn deposit, right? So there's a lot of things you can do on the Terra ecosystem, just on Anchor and the Mirror protocol, right? There's so much flexibility. So hopefully this made sense. So on my initial capital, my annual income should be roughly $8,600. Yeah, roughly, right? And I do have exposure to the Luna token, right? So right now Luna is down like roughly 10% or something ever since I purchased it, which is like not great, but I didn't want to speculate on the price of Luna. And I'm earning like 95% APY on Anchor tokens, right? So by using Luna as collateral and borrowing against it, I'm essentially increasing my anchor stack, right? Because, you know, if you're bullish Terra, then it kind of makes sense to farm all these tokens. So yeah, hopefully that made sense. Let me know if you have any questions. And I think this was like the easiest way to lay it out, right? Just like using a table, like all that is math, but let me know if that makes sense. So, but what if you said like, I don't want to speculate on the price of Luna. I don't want to go over, I don't want to use this step to like borrow against it, right? This seems awfully dangerous. If Bitcoin dumps, then I might get liquidated. And that's a totally valid argument. So what if you just purely wanted to just use stablecoins? Well, you see here, right? So let's say 16.4K, right? At the end of the day, it doesn't really matter what the number is, right? Because the rate of return is going to remain the same, right? Because math, like, I'm Asian, you can trust me. So let's just say you just put everything into Anchor, right? 16.4K of UST, right? And then you're earning that much. Well, you can use 16.4K as collateral on Mirror to short farm, right? It means the same thing. Go back to spreadsheet. So let's just say you like short at $8,000 worth, right? Because you want to maintain like a safe collateral ratio. And then assuming that, you know, these rates stay the same, then you can earn $3,600. And then once the short funds are unlocked, you can long farm it again. Or if you're even like more risk averse, you can take the $8,000, put it back into the Anchor earn deposit and do that, right? So you can do this. You can do this as well, right? And it's still 50%. So, you know, there are many things you can do on the Terra ecosystem. This is why I wanted to just move all my stablecoins there, right? And I also purchased some Luna tokens just because, I don't know, I'm a degen or something. So let me know if that made sense. I think this is a pretty good overview of what you can do on Mirror, right? And also, I'm like earning Anchor tokens here, right? I'm earning Anchor tokens. So over time, as I don't know, like earn like $200 with Anchor tokens, you know, it's not that much, but you know, I'm also farming it for free. And if you go to the, if you go to the govern tab, whatever Mirror token you earn, you can stake it here for 15% APR. So, you know, the actual number here might be higher, right? Obviously, like you're being paid in Anchor and Mirror tokens, and if these values go down, then the APRs go down. But if it goes up, then the APYs also go up. So, yeah, thank you guys for watching the video. Hope this was helpful. Just laying it out on the table like this. Thank you guys for watching, and have a nice day farming.